posting that surprise profit in the first quarter, and we saw the stock just surge. It's been on a tear despite that massive cash burn and still a lot of uncertainty of when they're going to resume production in the U.S. Why do you think that is?
Well, we should look at the quarter not just in the financial results tonight, but also in what they reported on deliveries 3 weeks ago. And if you look at both of those in context, the reason why the stock continues to move higher is that they are the best positioned automotive maker for the next decade. And evidenced by their growth in deliveries that they reported a few weeks ago, plus 40% versus in the U.S., not a perfect comp, but that was the U.S. auto industry was down 29%. So we're talking a 70% gap, a 70% gap between those two. So that's one thing, is that people simply want their cars. They also talked, just fast forwarding to tonight, what was impactful was the margin on those cars was better than expected. They actually improved their gross margins from 18.9 to 20%, which shows some efficiencies from Shanghai Model 3 production, and also Model Y being as profitable in its first quarter of production. That, recall, a year and a half ago was the challenge with the Tesla story, is extreme pain in terms of building the Model 3 and building it in a profitable way. And so what they're showing is two things. One is some greater mastery of production, and separately a product line that consumers want, and that should justify a stock, a company that's worth more than its current $160 billion.
That cash burn of nearly $900 million, though, I mean, it's largely due to, of course, the production constraints in the U.S. and their Fremont plant, but they also have a huge chunk of inventory that they can't sell because of the pandemic. Is this still going to be a concern, or are investors continue going to overlook this?
Thank you for reminding me. That was the substance of your question, is that cash burn. And you're exactly right. Is they had 14,000 vehicles that normally at the end of a quarter, they will surge in these deliveries. They deliver the majority of their vehicles in the last few days of every quarter. And in this case, things got shut down 10 days before the end of the quarter, and so they weren't able to deliver that. And so essentially they had built these cars, they had spent the money on them, but they hadn't taken the revenue. And so this was an anomaly. They will start to deliver some of those cars. They've already started to deliver those in the April quarter, which should help some of the cash. But that is still an important part of the story. I mean, our takeaway here is that 2020 is still going to be a wild card year for Tesla. I think that this company should grow in valuation over the years to come. But ultimately is that there's still a lot of unknowns outside of Tesla's control about what the June quarter looks like and what will happen with the cash burn in the June quarter. Good news is that they have just over $8 billion at the end of last quarter, and so they should be able to sustain this level of uncertainty for about a year and a half. They've got plenty of cash. Very different story than a year and a half ago.
Gene, one of those uncertainties is the supply chain issues that Tesla's faced, along with many other companies, of course. Do we get any more transparency on how much progress they're making on that issue?
Yeah, it sounds like that there's many parts that go into a car, many suppliers. It sounds like the majority of those are back up and running, but of course you need all of the components to manufacture a car. And there is changes in some of those, how those suppliers are supplying Tesla even today. So it is a week-by-week basis. The simple answer is this, is that in the June quarter, it is going to be, there's going to be headwinds. It can be potentially messy for Tesla as well as most companies on things like production. And so it is to be determined. I think what is the way we think about that is when mobility hasn't changed in 100 years, Tesla is advancing that with EV and autonomy. And so a few quarters of a lot of messiness is a small piece of what is going to be a massive secular shift in the years to come.
Gene, we want to get your thoughts on Apple, but before we get to that, what is your price target then for Tesla by the end of the year, weighing all of these factors up?
Well, we let investors decide what the exact price is, but I can say this, is that the company that is leading in electrification and autonomy should be worth more than $160 billion, and I think meaningfully more than $160 billion. I think that this should over time be $200-300 billion type of a company. And so I think there's plenty of room in the years to come in shares of Tesla.
And Gene, switching to Apple now, this is going to be the next big one, of course. In February, they said they would miss their revenue targets. How bad is it going to be? How do you think Apple really held up during these extreme times?
Well, they're going to get a pretty good headwind in March and in June. And if you look at the Google results, they have a very small hardware business, but they said that business was more acutely impacted than their search business, which held up really well towards the end of the quarter. It was basically flat in the last 3 weeks of the quarter. But the hardware business did impact it. So to answer your question is, how do we think this plays out for the March quarter? Apple, I think that the revenue, the iPhone revenue could be down 25% year over year. I think it could be down a similar amount in the June quarter. And so we are bracing for some bad news, but I don't want that to be construed as I think that the stock, despite that, can move higher on that bad news. And we've seen just simple comments from Facebook talking about an improvement. A stabilization was the word that the CFO used in the month of April. You heard Ruth Porat from Google 2 nights ago talking about the some signs of returning to normal. Any indication about life fractionally returning to normal will be viewed as a positive. And the benefit that Apple has is they have businesses. They're one of the few U.S. tech companies that really does a lot of business in China, and I think that they can use some of the evolution, even though we're not out of the woods by any means there. I think some of the evolution and how things are recovering could be encouraging for Apple investors, that wave of recovery is going to come in the months ahead.
How do you think services are going to fare during these lockdowns? People are stuck at home for most of the quarter. Do you think it's enough of an offset in the slump in iPhone's sales that we could see?
Well, it's not going to offset all of it. And overall, I mentioned that the iPhone revenue will be down 25% in the quarter. The good news is that the services segment should be up about 17%. That compares to about 15% growth in the previous quarter. There is an unknown about how some of the Google contract, that's a measurable part of their services business. But think of this as an accelerating business quarter on quarter. And then there's wearables. Apple doesn't break out that segment. It's about 8% of their overall revenue. We've been tracking it based on periodic comments they make, and I feel confident that these numbers are within a small amount of the actual reported wearables numbers. And specifically, as we think that the wearables segment is going to be up 24%. So the bad news is iPhone gets hit. Good news is services and wearables continue to do well, and I think that the company is doing a brilliant job of really weaving together hardware and these software services, unlike any other company. And I really I fast forward to things like services and what they're doing in healthcare and 5G and wearables as one of the fundamental reasons why I think Apple will be one of the best performing FANG stock this year.
And they've got about $100 billion cash pile. Do you expect them putting that to use, that cash pile? Are they going to change their dividend, their buyback policy at all?
Well, I think they're going to leave it as is. There are expectations that they will raise it. Some expectations they're going to raise it materially, up to $75 billion, for example. That was the amount that they raised the buyback a year ago. So there is a precedence for that. But this is these times are abnormal. And so I think that they will maintain that. They do have a goal of reducing their cash balance. They want to be what is called net cash neutral, which means that essentially they still have almost $100 billion they want to return to investors. They haven't given a timetable on that. I think they will maintain their dividend and probably revisit in the quarters ahead if things, in fact, do stabilize.